The stock market is currently open for live trading, and right now, Nuburu Inc., trading under the ticker symbol BURU on the NYSE American, is sitting at an exact live intraday price of $0.073 per share, marking a massive intraday drop of 39.21% during this active session. While a plunge like this looks catastrophic on a standard charts ticker, the underlying reality is far more complex than a simple market sell-off. Today's massive price collapse is directly triggered by an aggressive corporate restructuring move, specifically the pricing of a massive $38 million best efforts public offering designed to fund a high-stakes acquisition and clean up the company's balance sheet by wiping out over $16.7 million in toxic debt. For retail investors tracking micro-cap stocks on retail investing platforms, this massive drop represents the classic conflict between corporate survival and brutal equity dilution. The general market expectation surrounding micro-cap industrial players like Nuburu is that they are highly volatile vehicles driven by speculative retail volume, easily manipulated by short-term sentiment swings on platforms like Robinhood. Many people look at the ticker and assume this is just another dying penny stock cascading towards zero. However, the reality hidden beneath the surface reveals a management team executing a desperate high-stakes capitalization strategy to stay alive on the public exchanges. They are intentionally depressing their current share price through heavy share issuance to aggressively acquire Techni, a move intended to anchor them in the lucrative international defense and counter-drone contracting markets. It is a stark reminder that what looks like a death spiral on an individual brokerage account can sometimes be a calculated, albeit incredibly painful, dilutive resetting of the company's entire corporate foundation. When you look at the recent trading metrics, the sheer pressure on this asset becomes blindingly obvious. The average trading volume for this stock typically sits around 36 million shares, but today's frantic activity has already blown past that, with over 39.4 million shares changing hands in a matter of hours, as institutional block traders and retail accounts scramble to adjust to the new offering price. This heavy volume shows that institutional players are actively shuffling their positions, forcing the stock to scrape against its absolute 52-week low of $0.0721, a staggering drop from its 52-week high of $4.24. Macroeconomic pressures, including tight credit conditions and high borrowing costs, have made standard corporate debt refinancing nearly impossible for companies of this size, forcing them to use their own equity as a printing press. The sector momentum for specialized hardware has been harsh, and when a microcap name announces a best efforts offering priced well below its trailing average, the market reacts with immediate, unforgiving downward force. To fully wrap your head around this asset, you have to understand exactly what Nuburu does when they aren't shuffling papers on Wall Street. The company specializes in the development and manufacture of high-power industrial blue lasers. Unlike standard infrared lasers that struggle with material absorption, blue laser technology is highly efficient at processing copper, gold, and other highly reflective metals. Their business model relies on selling these advanced laser systems to manufacturers in the electric vehicle battery space, consumer electronics, and aerospace sectors. In their older financial reports, the structural weaknesses were obvious. For instance, their annual net income for December 2025 showed an alarming loss of $79 million on minimal revenue, showing a business burning cash rapidly while trying to scale complex commercial hardware. Past performance has been heavily marred by these persistent capital shortfalls, leading to compliance warnings regarding listing minimums, which they only recently managed to temporarily satisfy via unaudited equity adjustments. This brings us back to the classic tension between investor expectation and brutal operational reality. People investing online through major platforms or seeking investment help from digital asset allocators often look at technology firms and expect smooth upward scaling once a core product is validated. But the reality of hardware industrial manufacturing is capital-intensive, slow, and full of regular dilution risks. Comment below how many shares of Nuburu you currently hold, or if you are entirely avoiding microcap tech stocks in this volatile market environment. The tension is amplified here because the company is trying to pivot into the defense sector with laser dazzler test campaigns designed for the counter-unmanned aerial vehicle market. While the expectation is that entering a $13 billion military market will drive massive future revenue, the short-term reality is that current shareholders are paying a massive price today via dilution to even enter the entry fee. Looking closely at the future outlook, there are distinct paths this asset could take from its current 7-cent level. The most bullish catalyst would be the swift closing of the Techni acquisition, followed by an immediate revenue ramp from military or industrial contracts that proves the dilution was worth it. If they can leverage their blue lasers to secure consistent, high-margin government defense contracts, the company could fundamentally alter its financial profile and reverse this multi-year downward trend. On the flip side, the risks are incredibly steep. If the best efforts offering fails to raise the full target amount, or if the integration of the new acquisition stalls, the company will find itself right back in a liquidity crunch with fewer equity levers left to pull, risking eventual delisting or further capital restructuring. When evaluating this situation against major market anchors like Tesla stock, Apple stock, or Nvidia stock, the differences in capital structure become incredibly clear. Large-cap tech giants can fund their R&D through massive internal cash flows, whereas a micro-cap firm like Nuburu is entirely at the mercy of capital market wins. Serious self-investing requires recognizing that while names like Interactive Brokers or SoFi Invest provide easy entry into these hyper-volatile assets, the underlying risk profile requires a different analytical framework than blue-chip equities. In summary, the central insight driving today's dramatic market action is not operational failure, but the severe dilutive cost of corporate survival. The market expectation focused on short-term stability was completely broken by the reality of a massive public offering priced to aggressively restructure debt and fund an expansion. While the industrial utility of high-power blue lasers remains technologically valid, the stock serves as a stark textbook case of how corporate financing decisions can instantly overpower product potential on the open market. For anyone managing an individual brokerage account or analyzing high-risk equities, the lesson here is absolute. Always watch the balance sheet and the share count, because the technology can be completely sound while the equity is being rewritten in real time.